Welcome to the Explainer. Today, we're diving into something pretty cool, a real-time experiment where an investor is letting an algorithm run their stock market strategy. Yeah, you heard that right. No gut feelings, no emotional trades, just pure, cold, hard rules. And we're jumping in right at the beginning. We've got a 4-month window into this publicly shared portfolio. It gives us this incredible behind-the-scenes peek at how a system like this, one driven by code instead of instinct, actually works and adapts right from the get-go. Okay, so let's get into the nitty-gritty. We're going to break down the core rules of the system, see how it's already changed in just a few months, and this is the really cool part, unpack its secret weapon for when the market goes haywire. It's a pretty fascinating look at what truly disciplined, emotion-free investing looks like. First things first, how does this thing even decide what to buy? Well, it's all built on a really simple, but honestly super powerful foundation. The whole point is to take guesswork completely out of the equation and just enforce pure discipline. At its heart, the strategy is basically dollar cost averaging, but with a twist. The algorithm puts in a tiny fixed amount. We're talking just $1 per asset on a regular schedule. But here's the clever part. It doesn't just buy everything in sight. Under normal conditions, it only buys into about half of the assets in the portfolio. So how does it pick that half? It uses this really slick two-filter process. Imagine you have two sieves. The first sieve filters for one set of criteria, say company size or industry. Then it takes what's left and runs it through a second sieve with totally different criteria, maybe something like recent performance. Only the assets that make it through both filters get that $1 investment. It's a super methodical, totally unemotional way to decide where the money goes. Now, obviously, a long-term strategy can't just sit still, right? This portfolio is built to grow and get more diversified over time. And you know what? That evolution is already happening. Get this. In just 4 months, the number of assets in the portfolio shot up from 20 to 30. That's a 50% increase. It just goes to show you, this isn't a set-it-and-forget-it thing. It's an active strategy of expansion right from day one. And this growth isn't just random. It's all part of the master plan. The investors specifically added things like global ETFs to get much broader market exposure. And it's not stopping there. The long-term goal is to get this portfolio up to 46 different assets. That number, 46, is probably the sweet spot for this investor. Enough diversification to spread out the risk, but not so many that it's impossible to track. Okay, but now for the really, really clever part. The crow move, if you will. What happens when the market starts to panic? When everyone else is hitting the sell button. Well, this algorithm has a very specific and kind of counterintuitive rule baked right into its code for exactly that moment. So when the market starts falling, what does this algorithm do? It doesn't panic. Instead, it follows a specific protocol that's already been programmed in. It's a pre-planned move, and it's all triggered by one very famous market indicator. And that indicator is the VIX Index. You've probably heard of it. It's often called the Fear Index. Basically, when the VIX spikes, it means fear and uncertainty are running rampant in the market. But for this algorithm, a high VIX reading isn't a red flag to run for the hills. Nope, it's a green light to go on the attack. So here's how it works. In a normal market, when the VIX is below 32, it buys into about half the portfolio's assets, right? But when the market is in high fear mode and the VIX shoots above 32, the strategy completely flips. The algorithm goes from buying half the portfolio to buying into the entire portfolio. It doubles down, buying $1 of every single asset. It is literally programmed to be greedy when others are fearful, snapping up assets while they're cheap. So when you put it all together, the filters, the steady diversification, this fear trigger, it becomes really clear what this is all about. This strategy isn't about making a quick buck. It's about playing a completely different game, a much longer one. The investor put it perfectly with this quote: "We should look at this like a business, one that needs 3 to 5 years to build." I love that analogy. It frames the entire approach. You're not just gambling on stocks. You're patiently building a business from the ground up. And like any real business, it takes time, years, not days, to lay the foundation and see real, sustainable growth. So what's the end game here? It's all about long-term accumulation, most likely for something big like retirement. The whole goal is to use time, discipline, and the incredible power of compounding to build wealth over a 5, maybe even 10-year horizon. This little 4-month snapshot is just a fantastic case study of a strategy built for the long haul.
one that takes human emotion right out of the picture and replaces it with cold, hard rules. And that really leaves us with a big question to think about for ourselves. What's your investment horizon? Are you playing for a short-term profit, or are you building for your long-term retirement?